Dalal Street ends Friday at a one-month low and ends lower for the second day in a row. Could the Nifty below 20-day moving average spell trouble for the bulls? And at current valuations, what kind of returns can we expect from the Nifty in 2023? And is the PSE index on the verge of a multi-decadal breakout? We discuss all that and much more in this week's edition of Editors Roundtable. I'm Reema Tendulkar. With me is Prashant, Anuj, Nimesh and Nigel. Hi guys.
We're actually a full team today.
Yeah, I missed out the last,
couple of things, yeah.
couple of episodes, but good to be back. And the market's not looking good, of course.
No Santa Claus rally.
Yeah, and especially the last couple of days, I think were brutal. Friday was brutal. I think Thursday the market preempted a lot of Friday decline. But Friday, the market attempted two rallies. Both were sold into. I think the message is loud and clear. And even in the US, I think the market got a bit cocky about what Jerome Powell was about to say and how the market reacted to that. And next day, I think it had a bit of a reality check.
Okay, so before we get chatting about the markets, quickly, the prediction for the FIFA World Cup
I thought
final.
we were keeping it for the end, but
Argentina.
I have said France 5-1.
5-1.
France 5-1.
I have said France 5-1. You know, when you make a prediction, make it as outlandish as it can be.
And bold. Argentina.
What about you? Argentina?
Argentina.
I think France. I mean, I would want...
So we are 2-2 now. Nigel,
yeah.
you're the...
No, based on form, it has to be France, so I'm going with France.
No.
But
Okay.
heart is with Argentina, so I'm going with France.
Okay, so 3-2 basically. Let's see.
But in the heart for most people would be with Argentina.
Argentina.
I mean, great South American football, so we'll see. Anuj, but the market is not looking all that great, right?
No,
And
it's
this
not.
20-day moving average we've been talking about.
It's not. And actually, you know what? It's decisively broken the 20-day moving average. Yesterday, it looked like maybe you want to still give it one more day.
Yeah.
But I think today, the way it just effortlessly broke that and the two rallies were sold into, anecdotally, what happens is the break of 20-day moving average leads to a sharp fall. And I think I have the numbers to back it. But before that, the Bank Nifty just about managed to close right at the 20-day moving average. In fact, the Bank Nifty's close was prevailing 20-day moving average. So I think that is still, you want to still give benefit of doubt to the Bank Nifty because it's the leadership index. But let's look at the last few instances of the 20-day moving average breakdowns. And most of this, I'm looking at this year only. Starting with January, on January 21, the Nifty broke the 20-day moving average. And after that, it had a 7.8% decline over a 2-month period. After that, we reclaimed that. And then in April, we had, on April 18th, another 20-day moving average breach. And guess what? This time also, the market fell 7.8%, the Nifty that is. Though this time, the fall was a bit shorter in duration. Come June 13th, the Nifty again broke the 20-day moving average. And this time, the fall was 6.8%. Again, this time, the fall actually lasted for slightly longer duration. And this is what would give hope to the bulls that the next breach of 20-day moving average was a temporary one on August 29, when it breached it and fell only about 3% and bounced back immediately after that. So December 15th, we broke the 20-day moving average. We don't know where it's going from here, right? But if you look at the broader market, there are some signs that, most of the market indices are actually at or below the 20-day moving average. The mid-cap index is right at the 20-day moving average. Metals index is at 20-day moving average. FMCG index is very close to breaking it, just 0.5% above that. Indices which have already broken that, pharma, auto index, no prices for guessing, IT index, 3.5% below the 20-day moving average. The two indices which have managed to do well, capital goods, which till yesterday actually was almost at a lifetime high, is still 2% above its 20-day moving average. And again, no surprises for guessing, the strongest index, the PSU Bank Index, which is 5% above its 20-day moving average. So these are few indices. In terms of stocks, again, no surprises, HCL Tech, Infosys, the ones which are the weakest, below the 20-day moving average. Kotak as well, down about 4%. Stocks with strength, you have ONGC, IndusInd Bank, and Larsen & Toubro. Larsen, remember, even yesterday's trade made a lifetime high. Now, the stocks that I'm watching out for, which are at a make or break zone, right at the 20-day moving average. The close today was at the 20-day moving average. What are these stocks? You have SBI, you have HDFC Bank. Both of these stocks right at the 20-day moving average. You have Reliance, ITC, and ICICI Bank. The three stocks which have led the market rally, they're now 2% below the 20-day moving average. If these stocks correct a bit more, then I think you are in for a sharper correction. That's what the anecdotal data tells us. Let's see if this time it's different or not. What are you tracking, Reema?
Well, I'm today talking about the correlation between the Nifty valuations and what in the past have been the kind of returns that we've seen when the valuations are at current levels. So currently, the Nifty is trading at valuations of 19.5 to 20 times. So over the last 2 decades, when the Nifty has been hovering around these valuations, what have been the expected one-year returns that we've seen. And we often hear from investors that Indian valuations are expensive, much higher than what emerging markets are trading at, and that makes them a little cautious in India. But what exactly are excessive valuations according to India's standards, historical standards? At what point does the risk-reward turn extremely unfavorable, right? That's what my piece is about. So let me start with the current valuation picture, right? Currently, as I said, we are at 19.5, 20 times, higher than the long period average, but we are not at the highest peak valuations. The peak valuations in the Indian markets from an Indian market context has been close to about 25 to 25.5 times. So here I'm breaking up the valuation versus the return argument into two buckets. One, valuations at expensive levels, frothy levels, and that I'm constituting at between 22 times to 25 times. Now, in the last 2 decades, there have been 4 instances when the Nifty has traded closer to that 23, 24, 25 times kind of valuations, and you would see in 3 of them, in 3 of these instances out of 4, the Nifty has given you a negative return. The worst has been, around the Lehman crisis when the Nifty fell close to about 50% in the next 1 year. These are the annual returns that we've seen when the Nifty is traded at these. Your best case has been only a 1% average forward return on an annual basis. So the point is, from an Indian market historical context, frothy valuations perhaps are closer to 23, 24 times, 25 times, and that's when the risk-reward has turned hugely unfavorable. Let's talk about India's current valuations, closer to 20 times. What has happened when we've hit these valuations in the past 2 decades? Well, as you can see, there are multiple instances when the valuations for a long period of time have been around that 20 to 22 times forward multiple. More often than not, you've got positive returns. But the extent of positive returns has been fairly moderate. Your best case has been low teens kind of returns, and on an average, you would have got, a mid-single digit kind of return. So the bottom line is that perhaps as we set to enter 2023, we are trading at valuations which are higher than a long period average, not excessive by historical standards, but maybe 2023 may not turn out to be a year where you get supernormal, returns. It could be a year where you get moderate returns, and that's what history tells us. Which then brings us to the next point that we're going to be talking about on Editor's Roundtable. If 2023 indeed has moderate returns, is it time to look outside of the equity markets, perhaps at debt? And Prashant, you've got some interesting analysis there.
We told our viewers about the problem, which is high valuations, 20-day moving average, etc. Let's tell them the solution also. And the solution perhaps is fixed income. This is according to S. Narain, CIO of ICICI Pru. Listen in, it's a 30-second bite, and then we'll come back and present some data.
If you look at the last month, what we saw was that debt index fund have received huge inflows, and that's something which possibly as a product didn't exist 2 years back. So I think clearly we are seeing a situation where people will consider debt and SIP both, and that will be the change which we will see in 2023. I think the big call will be that inflation will become